You deferred $150,000 this year. Smart move. Disciplined. Exactly what every compensation consultant in your company told you to do. You lowered your W-2 income, reduced your marginal federal exposure, and you told yourself you were playing the long game. The kind of long game only executives with genuine financial sophistication understand. Here is the problem. That money doesn't exist in a vault with your name on it. It exists as a liability line on your employer's balance sheet. And the moment a private equity firm acquires your company, you stop being a valued executive. You become a creditor, an unsecured one. That distinction between executive participant and unsecured creditor is the most expensive sentence most high-earning women will never read in time. Non-qualified deferred compensation plans, NQDC plans, are not retirement accounts. They carry zero ERISA protection, zero fiduciary mandate, zero government insurance backstop. Your 401k has legal armor built around it by federal statute. Your NQDC plan has a promissory handshake from a corporate entity that, right now in 2026, is actively being repriced, restructured, and in many cases, quietly liquidated. The 2026 corporate restructuring cycle is not a market correction. It is an engineered harvesting event. Private equity acquisition volume, targeting mid-cap and large-cap corporate structures, accelerated sharply after the 2024 interest rate recalibration. When leverage becomes expensive, PE firms compress costs aggressively, and the first line item any restructuring algorithm targets is top-heavy executive payroll, specifically, deferred compensation obligations sitting on the books as unfunded liabilities. Let that architecture sink in. The very discipline that made you financially sophisticated, deferring income, optimizing your tax position, created a concentrated liability that now sits directly in the crosshairs of a buyout model. Here is precisely how the mechanism works. Under IRC Section 409A, NQDC distributions are governed by a rigid schedule you elected years in advance. You cannot accelerate a withdrawal because your company just announced a merger. The IRS does not care about your anxiety. The only distribution triggers 409A permits are separation from service, disability, death, a change in control event meeting specific IRS definitions, an unforeseeable emergency, or a preset fixed date. That's it. And change in control under 409A is far narrower than the boardroom definition of acquisition. A PE firm acquiring 60% of your parent company's holding structure may not legally constitute a 409A change in control event, which means your distribution clock doesn't reset. You remain locked in inside a corporate shell that now has entirely different ownership incentives. Meanwhile, if that restructured entity files for Chapter 11, your deferred compensation claim ranks alongside general unsecured creditors, behind secured lenders, behind DIP financing, behind the bondholders. A 35-year-old woman who deferred $400,000 over 6 years inside a company that subsequently enters bankruptcy recovers, on average, cents on the dollar. The research on unsecured creditor recoveries in corporate Chapter 11 cases consistently shows recovery rates between 20 and 40 cents per dollar. And that is before legal fees erode the residual further. This is where the psychology of the good soldier becomes a financial liability. High-earning women inside corporate structures are disproportionately conditioned to defer gratification, defer income, defer recognition, defer authority, as a signal of loyalty and long-term alignment. That behavioral conditioning is actively exploited by compensation architects, who know that a well-designed NQDC plan increases executive retention at near zero immediate cost to the company. The company books it as a future liability. Your deferred compensation is, in its most precise legal description, an IOU from a corporate entity whose credit quality you did not independently stress test. You stress tested your investment portfolio. You optimized your asset allocation, but you treated your employer's balance sheet as bedrock. Consider a 38-year-old VP of finance at a mid-cap consumer goods company. She deferred $75,000 annually for 5 years, $375,000 in accumulated deferred compensation. Her company is acquired in a secondary PE buyout. The acquiring firm immediately initiates a workforce restructuring. She is separated. Under 409, a separation from service rules, her distribution schedule kicks in, but the mandatory 6-month delay for specified employees applies. 6 months later, the entity is navigating a distressed debt restructuring. Her claim is now in legal limbo. Real income she already earned. Tied up in a corporate dispute she has no standing to accelerate. That is not an edge case. That is the structural design of the instrument, working exactly as written. Here is the systemic revelation that changes how you read every NQDC enrollment packet going forward. Call it the deferred loyalty premium, the hidden cost extracted from high-performing executives who optimize for tax efficiency inside institutions they implicitly trust with their unsecured capital. The deferred loyalty premium is not accidental. It is an incentive structure that benefits the corporation's near-term cash flow, the compensation consultant's fee, and the PE firm's acquisition model, while concentrating the tail risk entirely on the executive participant. The tax deferral is real. If you are in the 37% federal bracket and you defer $100,000, you legitimately avoid $37,000 in immediate federal tax liability. That math is accurate. But that math assumes full recovery of the deferred principal. The moment recovery probability drops below 63 cents on the dollar, the tax deferral strategy has negative expected value. You are better off taking the income, paying the tax, and deploying the after-tax capital into assets you legally own outright. The actionable structural shift is this. Treat your NQDC balance as a concentrated, unsecured credit position in a single corporate entity, because that is precisely what it is legally. Apply the same credit risk framework a sophisticated fixed-income portfolio manager uses. If your deferred balance exceeds 10 to 15% of your total liquid net worth, you have a concentration risk problem that no tax optimization benefit can structurally justify. Request a Rabbi Trust analysis from your plan administrator immediately. Some NQDC structures are held in Rabbi Trusts that, while still technically accessible to company creditors in bankruptcy, offer marginally stronger organizational protections than completely unfunded plans. More critically, stress test your employer's credit profile. Review public debt ratings, leverage ratios, and PE ownership vintage cycles annually. A PE firm that acquired your company 5 to 7 years ago is approaching its typical exit horizon. That is your earliest warning signal. Your deferred compensation is not a retirement strategy. It is a credit instrument. And right now, the credit quality of the issuer deserves your full analytical attention. The moment a restructuring event crystallizes your NQDC exposure, it simultaneously activates a second, far less visible liability that most executives never see coming until it surfaces in litigation. The same corporate restructuring wave that devalues your deferred compensation also repositions you, specifically as a high-earning female executive, as a measurable financial target inside the organization's liability architecture. Click the video on your screen right now, and let's pull back the next layer to dissect exactly how female executives earning at the $2 million net worth threshold are being systematically identified and exposed through invisible corporate liability vectors that have nothing to do with performance and everything to do with what's sitting on your personal balance sheet.